Okay, cool. So I'd like to kick off just before we introduce the panel and have them come up. I'd just like to kind of give you a little background. The time and the setting is 2017. Everybody is not operating cross-chain at all. The chains that exist are minimal. There's Bitcoin, Ethereum, and then other chains. DEXs are an idea that people can think of, but actually nobody really uses them. Ether Delta was kind of famous at this time, and then IDEX thereafter. But the liquidity was really bad. The UI and UX were not great. And essentially, we were all basically battling for liquidity. Liquidity was the problem. How did you get enough liquidity behind your token, your project, to actually have it be traded and have it be able to become kind of accepted by the centralized exchanges? Sometimes you'll kind of see in Telegram channels and things like that, the remnants of this. It's expressed in the phrase "when Binance." You might have seen that. When Binance basically is traders wanting their token to be listed by a centralized exchange that had enough liquidity to prove that their token and their project was, mainstream. And so that search for liquidity has been with us since the very beginning of crypto, and it continues today. And now we've kind of fast forwarded 6 years on, we have an entirely different panoply of L1s and L2s, but the same issues still occur, where we need liquidity to be available. And the problem now, or not so much the problem, but the exciting challenge now, is that chains, initially when they came up, you bought Bitcoin and then you bought something else. Maybe you bought Ethereum and then you bought something else. You had to go through those two chains. Now we have people coming into crypto who probably even never owned Bitcoin. Some of them are straight Solana, straight SKALE, or whoever it is. And so we have a different group of people joining, and we need to bring these different kind of isolated chains together so that our liquidity can compound and we can collaborate and work together on building up each of our skills and open the kind of space much more widely than it's currently open. So to talk about that today, we have some experts on our panel. So I'd like to bring them up. We have Fabio, if you can come up. So Fabio is from SKALE Network. I'll actually let him introduce himself in a second a bit more deeply, but I'll bring everyone up first. Then we have Benedetto, and from Folks Finance. We have Krzysztof from University of Zurich and Blockchain Center, and we have Brian, who's representing Partisia Finance. Cool. Thank you. Everyone grab a seat. Okay, and so we'll start off today with just kind of an introduction. If you can open up your lives a little bit to the audience and tell us a little bit about what you're about, or at least what your organization does and what you do within it. And then I think we'd like to start off, I think, with a bit of a broader scope, envisioning what you see as the future of cross-chain liquidity in your view. So let's start off just kind of going down the panel. So Fabio, maybe you can start us.
Can you hear me? Yeah. My name is Fabio. Hello. I'm heading up the SKALE Foundation, the business operations side. I've been in the space since 2016-17, started at Bank Frick. We were a team of 3 people, basically the only ones offering banking solutions back then to crypto projects. So I've seen a lot of projects popping up in 2017, those ICOs, mystical, some of them, well, most of them are not around anymore, to be honest. The strong ones which survived, they're now the leading ones. Then in 2021, I joined the SKALE team. And SKALE, for everyone who doesn't know what SKALE is doing, we're an EVM-compatible scalability solution offering a zero-gas fee network, modular solution, because everyone loves that term now, modular. We've been around since 2018, so we've been probably one of the first ones using that.
Awesome.
My name is Benedetto Biondi. I am the CEO of Folks Finance, which is the largest DeFi app on Algorand. The app offers a wide range of DeFi tools, ranging from lending, borrowing, liquid staking, swaps, leverage trading. And our mission is to build a better alternative to centralized exchange, because we believe that DeFi is very difficult to use and fragmented between the different protocols, as well the liquidity. So we want to give a future to that where users can enter in one single app with the most efficient liquidity. And that's why, in order to scale, we have chosen to build cross-chain native, and we are using Wormhole and CCIP in order to build a hub and spoke lending protocol. We'll be happy to dive this better later on how it works. But also we integrate other cross-chain partners in order to have a very efficient liquidity model that is solving the problem of standard multi-chain DeFi protocols.
Excellent. Chris?
So, hello everybody, my name is Gogol. I'm very happy to be here. I'm a tech entrepreneur, initially in the fintech area, now in DeFi, decentralized finance. But I mean, together with my entrepreneurial adventures, I'm doing PhD at University of Zurich at the Blockchain Center. I mean, at that center, we are trying to combine knowledge from the computer science, legal, and economics, like to provide a holistic overview on what's happening. And I'm particularly researching decentralized finance and blockchain scaling and security. So for me, cross-chain liquidity means that in the future, we will be able to use any blockchain we want without really realizing that we need different wallets on different networks. We'll be able to trade different currencies, maybe CBDCs, and everything is going to work seamlessly.
Excellent. Great.
Brian here with Partisia Blockchain. I'm one of the co-founders. Personally, been in the space since about 2013. I have 5 patents granted in blockchain technology in the U.S. Patent Office. Most of them are about combining MPC technology with different blockchain use cases. So Partisia Blockchain specializes in MPC, multi-party computation, and we integrate it into the core components of our layer 1 blockchain. So when it comes to cross-chain liquidity or transactions, we have a decentralized network of 100 node operators that are using threshold signature schemes to validate all the different blocks and transactions. So whether you're transferring data across different chains, both EVM and non-EVM, or assets, we facilitate the process. So it's really about actually having a decentralized way of doing cross-chain asset and data transfer. So if you kind of look at what we do, 100 node operators, threshold signature schemes, compared to some of the alternatives, which are kind of centralizing into 1 or 3 nodes, using like Google Cloud Provider and things like that. So we try to kind of stay to the core competency of what the use of a blockchain is supposed to be. And so we also debuted a key management product yesterday that's with that same focus. So with that said, thanks for having me.
Excellent. Thanks for joining. And I think that this is a key point we're going to talk about in a question a little bit later, where when you go cross-chain, we need to think extensively about security because we're dealing with consensus, differences in consensus protocols, but we'll talk about that in a minute. But excellent for bringing it up. We might start with you, actually, Brian, for the first question, just talking generally about cross-chain so everyone kind of understands. What's the key advantage of doing cross-chain? Like, why do we need to do this at all? Why don't we just use what would be the alternative?
One giant master ledger?
Yeah, exactly.
Well, I think the idea is that you need, competition breeds quality. So if there was one master network, it may not have the incentive to keep improving performance. There's people who make counter arguments to that, like Google's a monopoly, and that's why it functions so well. So I guess you can kind of argue that. But I wouldn't say it's more the advantage. I think it's just the way it is. There's people who are building products that they believe in and they think it addresses the problems that the industry is trying to solve. And you need lots of different entrepreneurial groups to try to do it because someone will do it right eventually. So I think it's just kind of the way it is more than an advantage. In a perfect world, we could say, let's have one perfect solution. But maybe Bitcoin is sort of that as the backbone of the industry.
Interesting.
Can I add a bit on?
Yeah.
Because I think that there is a lot of misunderstanding between multi-chain and cross-chain. So sometimes people may think that is the same thing. But for example, for a protocol, when talking about multi-chain, for example, in the EVM space, you have main apps that have been building on Ethereum, and then to fork, to be multi-chain, they fork their software into another network, right? And this is the standard model. In that case, you are just having a twin of what you had natively on an Ethereum, and that is the multi-chain model, which is okay, it works, it is good for expanding a product, but itself, it's not the best way of building. Indeed, the new cross-chain narrative, it works between interoperability of the networks. So the same app, instead than expanding by simply forking, it will be indeed building in a new way where the two networks are interoperable. So both the liquidity or even the user experience of transacting on network rather than another is much better and simpler. That is why, for me, the cross-chain narrative, it's much more important if we want to expand DeFi, because otherwise, if we stick to multi-chain, we are going to fragment the liquidity and the users in different networks, and this is not helping the industry. Rather, we would like to have a future where it doesn't matter the app that you are using, but you will be accessing the liquidity on all the network that supports.
Yeah, this is a good way of putting it. Yeah, exactly. And kind of bringing those two ideas together, like, so if we go to Brian's idea of the Bitcoin network maybe being the way to do it, everybody would then be limited by the Bitcoin network. And so you're coming up with different chains for different purposes. And maybe talking about scale just before with Fabio, there are different use cases for different chains. So how does scale kind of, what are the benefits of scale and thus it needing to be its own chain to need cross-chain liquidity?
Yeah, exactly. So Scale is a multi-chain network itself. So we have 20 EVM blockchains within the Scale network right now. And the interesting, well, kind of an interesting fact is back, well, 1.5 years ago, there were applications on all those several chains, and they faced issues with liquidity. And the problem also is we're one Scale network, but we have 20 Scale chains. So all those different tokens, even if there's, like, for example, a USDC token on one chain, it's a different token kind of on another blockchain. So that token mapping is getting super difficult. And we figured out a solution. So we created hubs. And now we have one liquidity hub. So one Scale chain is specifically here as a liquidity hub. And all liquidity is coming from all the other networks to the Scale network, is bridged to that specific liquidity hub. That's how we solve the kind of like, well, it's kind of like not a cross-chain, but multi-chain liquidity, which we solve, because that was an issue. And I think many protocols which are now looking into that modularity, they might face a similar issue. So we kind of focus just on one liquidity hub where everything is pooled and bridged over, and then from that chain, it's bridged to all the other Scale chains in the network. Because otherwise, yeah, token mapping would just be way too complicated.
I think also a very interesting example to bring on that topic is because we mentioned the token also, for example, Circle with USDC, they were deploying USDC in many chains, and then they launched CCTP, which is the cross-chain transfer protocol. So you are able to seamlessly deploy and transfer USDC on the different networks that they support, and this is so much better compared to the standard bridging between the multi-chain model.
That's a good point, really good point. And I think what it's coming to, the key thing to understand is underlying this is security. Like the more liquidity you have behind your chain, the more, let's say, so that with Scale, it might be an example where the security comes from the central chain and then is provided out to other chains. Chris, do you want to maybe go into a little bit of the risks of going cross-chain? Like why can't everyone just do it? And what are some of the problems we face right now with just being able to do it?
So we are still at the early stage of the cross-chain technology. As you mentioned, there are some risks related to keeping everything on one chain. I am like a big believer in layer 2 blockchains. This is what the previous panel was about. These are the blockchains that are actually relying on the security of the Bitcoin or Ethereum because they are the biggest and the largest networks. But we need, no matter at which blockchain we need to access liquidity from other chains. And we need to do that for the lower fees, for the more attractive interest rates in DeFi protocols, for lower exchange costs. So maybe I'm talking from the point of view of a DeFi researcher, but this is where really for me, the biggest value proposition of the blockchain is coming from. And maybe the risk that the cross-chain communication is bringing is the delay risk. I mean, we are used that on the blockchain, all of the transactions are atomic, which means that we know that our transaction is going to be executed or we are going to get the money back. When we're talking about the cross-chain liquidity, with the current state of the technology, we are not at that stage yet.
This is very true. I can add an example, practical on that, because when we were choosing the hub chain for the new cross-chain protocol, we were looking at many EVM chains and, of course, layer 2s. So being a lending protocol, taking a loan and having the settlement on a layer 2 will take up to 10 minutes. So this is a terrible user experience, at least for the stage of the technology right now. So we have been opting for Avalanche, for example, that guarantees us some much faster finality. So this is very true and brings risks for those builders that don't want to respect it. And as well, I believe that more risks comes and security problems comes being the messaging layer and the bridges, relatively new technologies compared to DeFi overall. We have seen many hacks. Most of the largest volume of hacks comes from bridges. So the audience is still skeptical in the cross-chain narrative because of that. But its technologies, through time, gets better. Protocol gets to be more reliable. For example, that is one of the reasons why we liked CCIP. It is because it had all the Chainlink infrastructure on the back, guaranteeing the security, so the reliability of the network for messaging.
This is really critical, because I think one of the things when we're talking about cross-chain liquidity is the understanding of what's happening when you're transferring one token from one blockchain to another blockchain. Essentially, you are moving from one consensus mechanism to another consensus mechanism, and one will be stronger than the other. But it's actually worse than that, because when you're bridging, and I'll let you guys jump in and explain it, maybe could you discover or describe some of the problems that have led to some of these bridge hacks, and essentially the stepping outside of consensus into like a centralized computer and then stepping out, and how we're starting to solve some of that. Maybe Brian.
Sure, yeah. There's kind of this, I think one of the issues in the industry is a lot of people are optimizing for like time to go to market. Which obviously makes sense because you have limited resources, so you kind of need to go to market, right? But it's also creating, I think, a culture of like not opting to try to build the most ambitious solutions. So like, for example, Partisia blockchain, we have a sharded protocol, so we can add more shards when there's more bandwidth needed. So it's like, if you're waiting in line to get into the club and it's really popular, we can open like 10 more doors so that there's more entry points. And unlike the EVMs, it's where all the liquidity is, so there's trade-offs, because if you're a developer and you just deploy on EVM and you want to do a lending protocol, it's a lot more feasible. You're going to have users who are ready to use it because it's within the user experience they're used to. But the issue is, if you look at Avalanche gas fees, like they kind of skyrocketed not so long, pretty recently. But in the beginning, they said it's almost no fee, it's low fee, right? Well, the truth is they're doing an EVM chain that was centralizing the nodes to keep costs down. But if you want to actually have a decentralized solution, you're going to have to change that, and then there's always a trade-off. There's more cost, right? So I think the big issue is when we build a bridge and we have 100 node operators running it right now, that's pretty decentralized. It can be better. But compare that to like something like Layer 0, it's like one centralized Google Cloud node. And I mean, I don't mean to call anybody out, and they can probably debate back and forth why theirs could even be more secure. So I'm not saying it means anything. But the point is, the hacks have mostly come from failures of like internal controls, right? The ability for someone to kind of enter the system with a backdoor because it was held tightly by the initial founding group or someone associated with them, right? And that's where a lot of the exploits come from. So until people are willing to try to build more ambitious solutions, like a super decentralized bridge that needs 2/3 of nodes to corrupt the network, or has collateralization under the amount of assets being transferred as backup security mechanisms, until they're willing to go all these extra miles and architect really custom solutions to the problems, we're going to keep repeating the same mistakes. And the really tough part about architecting and actually then developing and delivering a solution and having reliable node providers, you need all these things to happen. Time is a much larger time frame, which means you have to spend a lot more money to keep surviving until it can actually go to production and get ready, right? And so, like we started building all this stuff for an open source layer one, like in 2019, right? And so, it's mainnet, but we haven't released like the underlying token yet because it's like a lot of trials, a lot of testing. It's not like a go-to-market launch and announce that you can park liquidity and get 10%. It's a lot more complicated than that. So I think just the conclusion is it's trade-offs. Go-to-market, decentralization, and security. If you want security, it needs to be longer go-to-market and a much more thought-out custom solutions to address problems instead of slight modifications on what works sort of today.
This is a really good point, I think, and it's something I noticed a lot in terms of, do you think the blockchain community in a way is sometimes its own worst enemy, where it wants to release the thing early and it throws out a huge, like 100%, yield on this?
Yes and
as a
no.
result,
Yes and no, because that created an atmosphere of entertainment and retention. Because people come and they try, and so they're the early adopters. I kind of call them hero use cases. We keep having a hero use case that bails us out a little bit. So like there was the ICOs that just bailed the industry out from being completely boring and limited to the money use case, which maybe was maybe that's how it should have gone. Jokes aside. Then there was DeFi Summer, which bailed us out again of flame out on too many projects launching that didn't have retention. Then NFTs came out of nowhere. And so we constantly keep getting bailed out by these sort of fun use cases. But that's kind of required to keep people in the circus, right? Totally. But to build use cases that NGOs can do private payment networks and things on a blockchain, we have to have our expectations properly set for how long those are going to take to mature. And so, realistically, I actually think like we're looking at the year 2030. This forum here is CRYPTO2030. That's a realistic expectation.
Yeah, definitely.
There's no reason by 2030 we can't have really seamless movement of assets and data that's secure. So as long as everyone's expectations are set to, hey, if you want to really solve a big problem, it's a longer roadmap, then that's fine. And then hopefully, I don't think we're our own worst enemy. We need hero use cases to keep us entertained in the meantime, and get new people testing things, even on a simple level. Yeah, that's a good point. I think they kind of actually go together.
Yeah, this is good points. Well, then, what would be, talking about this, what would be really significant implementations of cross-chain liquidity that maybe you guys could speak to?
Actually, I can give you some example from Switzerland, because I privately believe that the times of the retail adoption of crypto, they will not come back. We'll be using a blockchain in the future without realizing it, but it will be more used by the enterprises and the financial institutions. And here, there is a topic of CBDCs that is actually very hot. But what took place last year in Switzerland is that a Swiss National Bank, together with Bank of France and Monetary Authority of Singapore, they simply implemented their own wholesale CBDCs on different blockchain, and then they used another blockchain with a DeFi application to simply exchange between them. And the project was actually a big success. And in my opinion, in the next few years, maybe before 2030, when we'll be doing some Forex transactions, they simply will be settled on the blockchain. Those of you that actually came to Switzerland from abroad, you will see when you go back home how incredible spreads you pay on your card for converting to Swiss francs. And those fees, they can simply go down significantly by using blockchain.
Interesting, yeah. So would you think that the fact that the public will be more exposed to digital currencies by virtue of CBDCs, they may be more interested in, or at least more aware of some of the risks that come with bridging, but then also what some of the benefits of really going for protocols that have thought it out and done the work.
And I think it also will be similar with the tokenization and the tokenization projects. That I mean, today we are going to a bank, or for example, when we are enterprise, we going to a bank and we take a loan, or we issue a bond. In the future, it will be the same. Just the bank will be issuing that bond on the blockchain, and then. I mean, the customer or the company, the factory that is going to the bank and asking for the money doesn't really care whether the bond will be settled on the blockchain or will be settled in the traditional finance. It will only see the lower interest rates. And when we'll be able to provide cross-chain liquidity to that tokenized bond, then simply those interest rates will be even more lower.
Oh, interesting. Yeah.
And once the registries of state-registered assets, like a home, for example, can actually be public and verifiable, it creates instant liquidity opportunities, because you could just simply have a pool that's like an AI could determine what your house is worth and put the bid right on the chain and say, you want the loan, here it is, collateralized with one click, right? And so that's super exciting stuff, but you need state participation to a certain level. And there's a whole deeper rabbit hole you could go into of that type of liquidity and asset management versus the banking system. So I'm sure it'll come up later in the panel. But I was having a conversation the other day, and it was super interesting because everything on chain is transparent, and so they try to restrict and do a lot of AML KYC on the blockchain. But the blockchain is AML KYC by default. If a crime was committed, it's permanently registered in the public domain. So you can reverse that and find everything, right? And so again, there's even less friction if you approach it the right way than the traditional banking system where things are secret, right? And so that's, I think, in terms of access to liquidity, is as soon as state registered verifiable assets, cars, houses are on chain, it completely opens up a totally free market where interest rates are determined by users.
It's true, yeah. And I mean, this is what Larry Fink obviously was saying when he started talking about tokenization recently on CNBC or something like that. But yeah, exactly. Just the ability to make those and know that they happened without any of the intermediaries of the banks and waiting the days and T plus, 7 days we're waiting to see if the BlackRock ETFs money is coming through. So yeah, absolutely. These make a lot of sense for cross-chain. And now we're talking about cross-chain not just within crypto, but actually crypto entering the TradFi world, as we call it, and actually starting to benefit those fields as well. So it's interesting, the innovation passing out and then probably back in again. Okay, so then, thinking about, I guess, overall dynamics of the market, what would you say the overall dynamics of cross-chain liquidity, what effect is it having on the crypto market at the moment? So you can see, for example, Ethereum has first mover advantage with lots and lots of liquidity, but then you have other projects coming up, maybe speaking to either challenges or interesting new developments that have happened in your fields recently that have allowed you to start to work across different chains. Maybe Fabio and Benedetto.
Yeah, sure. I mean, from an infrastructure, from a blockchain side of things, we were strongly focusing on growing our ecosystem community. And nowadays, we're a top 3 chain with transactions and users. And now we have the community, the ecosystem, but just a few months ago, half a year ago, all those, I would say decentralized exchanges, liquidity providers, they were not interested in us. They were like, well, why should we offer our services on your chain or one of your chains, because there's no traction. Nowadays, it's different. Nowadays, they approach us. They're like, oh, you actually have users. We can make money, so we obviously want to build on you. So we had that chicken and egg problem. I think everyone's facing that at some stage. And we, lucky enough, we now see all that traction on Scale. So we're now at a stage where we started the DeFi campaigns and ramping up that whole ecosystem, that industry, which we haven't had just half a year ago, basically. And now, I mean, yeah, with help of other solutions projects, we can actually start and go strong in that direction as well with more liquidity on chain, because users need it.
Well, speaking, you were pointing to Benedetto, maybe explain what you were...
I think the cross-chain narrative is going to change a lot the scenario, especially of DeFi, because, of course, it's like restructuring everything. And as we started with DeFi, let's say with the DEXs and then the lending protocols, it's going again through the same narrative, starting from primitives to be now switching from the multi-chain narrative to the cross-chain. And the cross-chain narrative, as Fabio was saying, looks at all the chain in a very different ways, because before, for example, a major lending protocol as Aave would look at the major chain where there is the largest volume and TVL in order to deploy. But indeed, cross-chain apps deploy networks in a much more faster way. So I was discussing before with Fabio, the approach that we are taking for the lending protocol, it works in the way that basically we can deploy the spokes contract. So we have AppChain, which is like the brain of the protocol and the accountant, which keeps track of all the loans that are on the different networks. And the other networks are spokes. So spokes have the same contracts that allows users to collateralize assets on the spoke and borrow from other chains. The stable coins comes from the hub chain, and other native asset stays in the other chain. So imagine a native asset on Scale can use it as collateral, borrowing USDC that will be flowing from Avalanche, and the user don't even know that they are borrowing from Avalanche. But in that scenario, we are basically empowering Scale's users with a lending protocol. We're borrowing with loans, which indeed, if we were maybe wait to Aave to deploy in Scale, it will take much longer. Indeed, with cross-chain apps, this comes much faster and better, because it's being cross-chain native. It means that you can implement many networks very quickly, and that's thanks to the messaging layer technology. The same is for swaps. So, for example, we use Li-Fi, which we really like. It's integrated, I don't remember, with so many chains, many networks. And for a cross-chain DEX aggregator, the narrative is very different. Before, let's say the story is like we had DEXs starting from Ethereum, and then the other version multi-chain on other networks. Then we had DEX aggregator, again, vertical. And now we have cross-chain DEX aggregator. So we are able to aggregate liquidity for swapping on Ethereum, on Scale, on Algorand, on Avalanche, all together. So you can imagine the efficiency of the swap is going to be so much better. And for me, the beautiful part is that the end user don't even need to know about that. Mm-hmm. So if I'm performing a swap, why do I need to know where this swap is happening? The only important thing that I care as an end user is to have the best price and this seamless experience. So that is, let's say, the new generation of apps will be powered by this cross-chain narrative. Same is for the borrowers in our case, right? If I'm taking a loan, why do I care where this liquidity is coming from? I just want to receive the liquidity in the wallet and in the network that I want, and that's it. So I believe that is going to change a lot the narrative of the different chains. Like it can change, because one chain can be vertical on, I don't know, we was discussing before, Scale can be vertical on gaming, right? But nevertheless, you need DeFi primitives, because it will empower your community, your ecosystem with tools to use, because of the composability, of course. And this is going to be empowering also minor networks compared to big networks that, let's say, they have all the tools already. Mm-hmm. Ethereum wouldn't need really the cross-chain liquidity, let's say. Mm-hmm. They are well as they are doing, right? But other networks will be taking much advantage from that.
Mm-hmm. Great, no, for sure. And so essentially, yeah, being able to essentially spin up chains that can focus on something specific and then lean on other chains for other benefits from them, rather than trying to be this all-in-one chain that does everything, has kind of had to be the useful or usual way of going about it in the past.
Yeah, because like also one example, right? If I want to swap, I want to buy Ethereum, and say I'm doing it on Algorand, the liquidity of it might be low. But if I'm on a cross-chain app, I might be doing it from my Algorand wallet and swapping on Ethereum natively. That is, then the swap is going to be much more efficient in terms of impact, price impact. Yeah.
Well, leading on from this question, maybe to Chris, what role does this play in AMMs these days? Are AMMs kind of an older model that are going out, and this is automatic market makers, or are they being improved? Or what would you say is, maybe both of you guys actually can answer?
Yes, so actually, in that example that I gave you previously about that cross-border trade of CBDCs, there was actually used. It was a fork of CRYPTO2030, It's like one of the smart contract, a computer program, which is simply running on the blockchain. And I mean, those AMMs we will need, to trade CBDCs, cryptocurrencies, but we always will need them for tokenized real-world assets, like tokenized bonds and other financial instruments. Because we often, there is, I mean, a lot of talking about tokenization, even more companies that are doing tokenization, but we often forget that it's not the act of tokenization, of using blockchain as a settlement layer, is bringing liquidity. It's like liquidity for those tokenized real estates, tokenized private equity investments. That liquidity is actually coming from using those automated market makers. It's not just from the act of tokenization. And those automated market makers, for those of you who doesn't know that model, they are like a computer programs that are simply deciding how much you need to pay for a token. Like in a nutshell, there is some complex mathematical formula. But the advantage is you can come, if you buy some, let's say, tokenized art, which is highly illiquid, 24/7, you can just go to that computer program and buy more of that art or sell it. And this is quite a unique value proposition. Like in Switzerland, we have companies, for example, Actionariat, that tokenize small and medium-sized privately owned companies, and they simply put them on those AMMs.
Yeah,
I mean, having said that, I think that the classical model will be used maybe for the tokens with a big liquidity, like maybe Ethereum, Bitcoin, that are huge, billions of tokens. Then they can be traded on CEXs or order books. But those smaller tokens, new tokens, AMMs are perfect.
Nice. Yeah, that makes sense. Well, then with, and maybe this is to Brian, with the kind of rise of restaking and restaking, and then so essentially what restaking is, you can stake your token and then you can still take that token and put it into an AMM. And so the ability to leverage your leverage, is this going to be a problem coming up? Is this what's going to, blow us up next time and then we'll grow back again? Or
if it's collateralized properly, then no, it's fine. People will just make mistakes and lose all their money.
Will it be in the rush?
Yeah. So, I mean, I think our perspective on AMMs is pretty clear. We're developing a more privacy preserving, like anti-front running AMM. So the big issue with the current system is the average user will put in a transaction and they'll pay their gas, but the miners can kind of see what's being offered and front run these people. So they could insert, and I'm not saying it's just the miners, could be anybody watching the chain. You can insert an order right in front of that other order. If you just pay a bit more, you can execute faster. And so basically every time you're making a trade as a retail user, you're kind of losing a little bit of money to somebody else. Right? What's that?
MEV bots?
Yeah, and there's even bots that do it for you after a certain point, and there's super experts who can do it like really well through, like you said, like advanced bots and trading. So if you're just the average Joe, typing in your thing and clicking the button, you're losing every time a little bit of money. So that's not really efficient, right? So you need some type of solution, and so dark pools is like a pretty common term. Those are used in real typical traditional markets, so you can't really see the bids or the asks. You just kind of know market pricing, and you can put in your bid or ask, and if it's getting filled, it's getting filled. But there's a secret pool that's kind of invisible, so you can't spoof the market. You can't put up a huge buy wall in the order book and make it look like there's tons of demand while you're selling off the top, right? Totally. So there's these little tricks in the market that people take advantage of. And with the AMMs, they're slow to execute. So, if you look at like traditional markets, trillions of dollars moving every day, they have fiber optic cables that they're running like direct to the source of the internet into their firm on the 80th floor in Manhattan.
As close to the
and
city
everyone's
as possible.
Plugged in, right? and that's who's you're competing against when you're trading, right? So if they're imagine like how easy it is for a group like that to just crush the AMMs all day, just beating everyone. There's a quote from Alex Gurko, who's the head of XTX Markets, one of the #1 traditional market makers in the world. he said, we're not necessarily better than everyone, but we're faster than everyone. And so until you can solve that problem where everything's super slow to finalize, so they're just, losing every time they try to trade, I think that's a problem, right? So until that's solved, and there's sort of this proper dark pool that, isn't being used to launder money, it's again, this is a big problem. It's going to take a long time to solve. So I don't see any instant solution.
Yeah, no, definitely. I mean, even Ethereum's roadmap kind of incorporates MEV as like a needed, or just like an unpreventable thing that needs to happen.
I think it's you're right. I think they made that like a stated priority of the chain, right?
Yeah. Try and figure, but yeah, this is. So let's take a different kind of turn now into the world of of the moment, which is AI. So what's the AI influence on liquidity matching and the ability for AI to actually help us smooth out the inefficiencies in the system? Has any of you been looking into anything like that or seen anything like that? Or
I think an issue with AI is to actually build custom solutions that work for you is expensive. At least currently, like computing power and the ability to, I think a few AI companies that I've heard of recently that are crushing it are companies that have like 20 years of massive data sets, and like they're able to create sort of like search engine indexing on data only they have and control, and then sell that as an enterprise package to other companies.
Interesting.
So like they've accidentally realized that they have a new gold mine that they can actually mine data out of. So those types of companies are going to crush because now they can apply all this to markets or other opportunities. But if you're an entrepreneur at home with no money and you haven't raised a check yet, I mean.
No, more for like
the
company
danger is like that the wealthy and the ones with access and resources can kind of capitalize first and create their own market efficiencies that suck all the money out.
Interesting.
So I'm not saying it's going to happen. I just think that that's like what I'm noticing happening personally.
Totally.
I don't see any friends of mine who just like whipped up a new AI product at home that couldn't just be made immediately by one of the bigger AI companies, which is what we've seen happen already.
Well, that's
cool use cases came out that were mostly user interface and experience on top of another big company's, massive language model, and then they get disrupted. So you have to, that's kind of an issue. Access.
Yeah, totally, for sure. And so, like, as a retail consumer, do we have a struggle in the future against AI enriched?
Definitely. I think BlackRock has been using AI for like 10 years. Right. It's Aladdin is the name, I think, of the product. So like they've already created market efficiencies for themselves. And managed to, accumulate $10 trillion assets under management.
Yeah, totally. So
that's not stopping. Soon. It continues. Now they have a Bitcoin ETF, they're hoarding all of the assets.
Yeah, it's interesting. So yeah, the price action of things will change according to a little bit their will and what they see.
Good.
But if I may add, actually, I fully agree that we are quite far from the moment when AI will be able to write production-ready codes. I mean, I simply wouldn't trust the code that was written by AI to transfer my money. So the jobs of developers are safe for some time. But there is another application of AI that's super interesting, and we are researching it at the uni. It's about fraud detection or threat detection, because AI can already read the code and, for example, predict how that code can be hacked. And this is what the models are doing quite well. Another application is actually detecting hacking attacks, because AI is also quite good in detecting anomalies. So it can be used to process the blockchain transactions and simply notice, okay, now most likely that protocol is being hacked, because the pattern that's showing up on the blockchain is irregular.
Okay. Will AI, this is just a random question out there, will AI be able to say, okay, let's give them an Arkham Invest address and say, okay, please assess when this person will be trading or best to go against them, a kind of the ability to kind of go, I guess, MEV to the plus degree or something. It's possible.
Yeah, I think those tools probably already are out there.
Yeah.
Like you can Whalebot, track different trades and things. And that's probably pretty simple to write a response mechanism based on certain things that happen. Say if they do this, do that. That's already there. I just think that that's basic level stuff, and the people who are going to win the biggest have extreme amounts of data that they're able to compute on. And then create new custom ways to approach the markets. And it's going to be really hard to compete against that.
Sweet. So the time is ticking somewhat, at least.
Yeah, I think so.
Okay, so if we were to, and we're going to come to some audience questions in about 5 minutes, but just to kind of start to wrap up towards the end of the panels talking on this, what would you say if you could pick one for cross-chain? Maybe it hasn't been invented yet, maybe it already is in CMM. What would you say is the killer app that allowed us to go from we must use centralized exchanges to now a world where we can use decentralized exchanges, where liquidity is big enough? What would you say? Maybe starting here and then coming down.
To be honest, well, killer app, just something which is easy to use, like with the best user experience ever. I mean, that's generally a Web3 issue, and I think cross-chain is even harder to solve that issue. And if there's something out there with an amazing UX, I think that would be one step in the right direction. In the background, I mean, then there are other players. But.
I've done a pitch competition on Monday about that. So at Folks, we are trying to do that at least for DeFi. So, but in general, we do believe that we are building fintech on smart contract, right? That right now is used for crypto, but as soon as tokenization will be taking more and more volume and assets will be valuable on chain, I believe that DeFi is going to go mainstream with that, and cross-chain liquidity is going to be, let's say, more used, and the mass adoption will come in earlier. But one thing that I'm very curious on when it could happen, it would be cross-chain yield product that uses messaging layer in order to outperform the yield. Because if we can improve more and more the yield for the liquidity providers, we will have more liquidity. So this means better liquidity for everybody. So it's also something that is going to boost adoption regarding that.
So here, I fully agree. I believe that tokenization is going to be that killer app that will bring the next billion of users, maybe even indirectly to blockchain. And for that, those tokenized products, they will need those AMMs and those smart contracts to simply process them. But I believe it's going to be driven simply by efficiency, that the cost will be lower, it will be easier to sell them, it will be actually possible even to sell them in small pieces. So it will be more like a pragmatic approach, less maybe dogmatic that we saw so far in crypto.
Makes sense.
Actually, I think social logins is the most underrated thing in the industry, because when you create a MetaMask or any of these, Ledger, you got to back up the key. It takes a few minutes. You got to hide under a blanket while you write your key down on the sheet they give you.
It's terrifying if
Yeah.
you're new. You're like, what?
But if you can use an authentication scheme where you just log in with X or Facebook or something, it's something that we're working on with the product we call Mocha. But basically, you have this decentralized network managing keys, right? And to authenticate your private key, you don't actually use the private key. There's a password that decrypts the private key for you, so you can make your own password. In the case of social logins, you already have made your password, and you've made a 2FA. So it won't authenticate your key until you go through both of those. You can still download your private key and save it, so if X ever disappears overnight or Facebook, you still have your private key. But I think that's the ultimate thing for onboarding. Anyone knows how to log in with their social handle, and they don't need to worry about the private key.
Yeah,
Technically, they should worry about it and download it still. And
Not
back it up.
everyone, SEC, not that much.
And you don't even need to. If you keep a low balance, if you're not putting your whole net worth in your social login, then you really don't need to care about the private key that much. It's like, okay, you lose a little bit of money, and it's not the end of the world, right?
Yeah, definitely.
But technically, with the social login, and if it's truly secure, which so far a few of the Taurus network is really good. That's never been hacked or gone down. I think they only have 3 or 4 validators controlling the keys. That's not enough. But the point is, I did this on one of the dApps that we're running, and it's just the user literally clicks 2 buttons, and now they have a wallet. They don't even know they're on a blockchain.
Yeah.
So I think that's kind of the key to everything, because unless it's that simple, we're not going to get the adoption that we
100%.
need. So, I mean, we only have 10 million monthly active users in the whole industry right now. That's nothing. You know, Facebook has a couple billion a day. So if we can use their login to open a wallet and take 2 seconds, let's do it.
Yeah, totally, for sure. Although the very crypto punk people would be appalled, but
Well, they're already appalled. There's an ETF on the
Exactly,
New York
yeah.
Stock Exchange. though, so that,
no, I totally
that
agree.
battle's
because-
already been lost.
And no one ever really asks the question, does everyone want to be their own bank? They just want to be able to sign in, make it be easy, and then, yeah, they'll
In
have...
terms of buying crypto too, though, like if you can take delivery to your social handle, it's much easier.
Oh, yeah, definitely.
So if you log in with your X and say, you know, from whoever you're buying off of, whether it's credit card or you link your bank, just
Venmo
deliver
style.
it to my @handle. It's easy. You don't need to like copy paste a long public key string.
Check the parts
Yeah.
of it.
And so you mean you could use it for advanced use cases too. It's even easier. It's like, oh,
Totally.
send my new house registry to my @handle.
Yeah, for sure. Yeah, this is cool. Yeah, it would be an exciting world, definitely. A lot
coming.
easier
It's
than
coming.
the current.
It's
Yeah,
coming.
absolutely.
And it's actually the sick part of all that is Facebook is the biggest beneficiary.
Yeah,
or
well, for
Twitter,
sure.
because now everyone who wants to use a crypto wallet is going to choose to go with their handle.
Yeah, true.
So they're even getting more adoption and growth without even doing anything.
That's a good point, actually. Yeah, which one will be the first?
Actually,
to
I
take
think
the shot?
Elon Musk has made it pretty clear that's like an agenda of X.
Yeah,
to make it the
exactly.
financial app. So maybe there's something coming there where it's actually non-custodial, where they say their handle is the new wallet and they use a key scheme. So maybe that's what's coming.
That would be pretty cool, definitely. Something to watch out for. Okay, well, I'll turn it over to the audience now for questions, because essentially we covered a lot of different topics and ideas. I do have one or two more ideas, but if we want to chat and ask the panel members anything specifically, either about what they talked about or cross-chain, does anyone have any questions or comments? Yes.
Question for Brian. I think you're the first person I hear like publicly calling out layer 0 for like the single
Oh, here we
relay.
go.
So,
I didn't mean to start this.
no, that's great. That's great. But just quick, we want to pick your brain on like, so why, like, if that's like such a like weak solution, like how come like, the raise like what, $450 million? So like, have we surrendered to the fact that like, we need this type of things quickly, like quicker than like, and so we give up, part of like the ethos of the industry, or like, are we just chasing yield and like tokens? Like what's
So the investors in large projects like that are investors. So like their goal is to get ROI, right? And the best way to do that is with usage, growth, users. And they've done a great job. I mean, everybody's using it now, right? So they came out, they got to market fast. It works. They haven't got hacked yet. Hopefully they don't. So from a investor perspective and a business strategy perspective, like that was maybe the best route for them. And hopefully for the industry side of it, we see over the next few years, like the promised product, which would be a really decentralized bridging solution. I don't know that. I don't really study their roadmap enough to know if that's what they're planning for or not. But I would assume that's what the ultimate goal would be for them. But I mean, look, when you can kind of get a large piece of market share and you haven't screwed it up yet, I mean, they haven't gotten hacked, no one's lost money, and it is a good solution that works. It's expensive, it's slow, but it's functioning, right? Look at the value they've created for themselves as an organization, right? So like they're executing from a business perspective like amazingly. So I don't think that it means we've surrendered anything. I think it's just like crypto users are willing to take a lot of risk. So I don't think it's a surrender, but I think let's hope that the full product materializes. And like they've also now de-risked a bit because they're able to have such a larger treasury. So now they do have a longer roadmap. So like approaches from that, which versus our approach, which is a bit more academic, a bit more test moves, like put the full solution out first rather than skip right to something, get everyone using it. Like you could argue maybe they made a better business choice, but in the long run, let's see.
But like those 10, like us 10 millions were definitely like risk takers. But like with those like 2 billions that we're talking about, like the Facebook users, are they risk takers? Probably not. So like, are we gonna onboard them with like these type of solutions, in your opinion?
I don't think that they have any clue what they're getting themselves into. So I don't think that You know, that's another thing is from the developer side of the business. I care about privacy a lot, but does the average user? I think there was like in 2018, it was the topic, like privacy, the hacks, Facebook knowing everything about you, but nothing seems to have changed, and people have kind of stopped complaining. So I don't know how it all ends, but the point is, if it works and it's secure, that's what matters. So as long as they manage to keep the ship together and it works, then they've done their job, right? And the same would go for us. You know, we're a more advanced, like decentralized solution in the market. But when the North Korean military sees $1 billion on chain and decides to try to attack your more secure solution, it still needs to survive that, right? There's no guarantees either way. And from a developer perspective as well, one of the developers on our team, there is actually an argument that having one control and one centralized thing to secure is easier to do, as long as the one controller doesn't screw it up and, like, you know, commit fraud or something. So, like, there's always a counter argument, sort of. So there's not necessarily right or wrong. It's just like, we'll see how it ends.
Thanks.
Do you think, like, just continuing this conversation, do you think that account abstraction will lead to like mass crypto adoption because it will be easier to log into the wallets and etc., or it will be the opposite when, like, true crypto people who are absolutely for decentralization, they will be like, no, that's not like the real concept that we came for, and they will be looking for some other solutions?
Yeah, quick answer, and then you guys can chime in. But I think it's good to have both. The easy login with social login or account abstraction for the daily user that needs small tasks and not putting their whole net worth in there. And then cold storage, private key management for the more advanced user. Like the beauty of it is we can have both. It doesn't need to be one or the other. And I think it's more important for the average daily user that they just get onboarded quick. So I think it's a net benefit.
Maybe Krzysztof, talk to the CBD. Like, what if we were to take this and say for a CBDC, like you would want to quickly be able to pay for stuff, but usually people's accounts are attached to their like big savings. How do we secure that without having to two separate account situation? Or will it be possible?
Yes, I mean, there's already work. I mean, that's why we need those different layers, layer 1, layer 2, layer 3, and more blockchains, or maybe some side chains. Simply, I believe we are going to keep maybe our savings on one blockchain, but for like a daily payments for the coffee, we are going to use another chain with that fast finality, that maybe there will be a risk that something might be lost or somebody can front run us, but because the amount of money is low, we simply don't really bother. I mean, we will also need the private blockchains because, I mean, who of us would like to live in a world where we see how much everybody's earning? I mean, I believe that in the future, all of us will be hired by DAO, so we also will be receiving our salaries, yes, to our wallets, but with the current public chains, yeah, once you know the wallet address, yeah, you will know salaries of everybody in the company you are working at.
Interesting. Yeah, that's a really good point, actually. The level of transparency is extreme.
I think the bank could become the new like private blockchain.
Yeah.
That's where like the AML KYC happens. They could run 24/7 instant transactions, and then they can manage all the private info. So I think we have like private smart contracts. The Red Cross uses one to do aid delivery so that the beneficiaries can't get discovered by the local maybe warlord or something. But like you could just offload the private thing to like, that's where maybe where the banking system stays relevant, right? Because they already have the processes to do AML, KYC. You can do instant transactions on a pretty centralized chain. And then if you have the proper bridging, you can go in and out of that system pretty easily, whether it's from ETH or Bitcoin or another alt chain.
It's an interesting point, because if you think about if Larry Fink is going to tokenize using Aladdin, let's say, and he takes Aladdin and keeps it private, the liquidity stays there. But if he uses something like Ethereum or
Yeah, they're not going to like allow it to leave, right? So
Yeah.
I think that's maybe where the private blockchains fit in, is in the existing system, which I think would be pretty good actually.
Yeah, yeah,
Fast, instant. It could run 24/7. No more closed on the weekends.
exactly.
These types of things.
Liquidity. It's good for not closing things on the weekends because essentially we can get to our bank anytime we want. Well, that's actually a good place, I think, to end up because we've 25 seconds left, so we're right on time. But yeah, I want to say thanks to everyone for coming on the panel. Thanks for coming to Davos if you weren't here already, and really excellent insights into the issue, and specifically because it's such a changing issue and it is so core to what we're doing. It's something that I think we could talk about every year, and it will have updates all the time. So yeah, much appreciated. Thank you everyone for joining.
Thank you, David.
Thank you so much, dear David and panelists. Maybe just quickly, David, we heard a lot of interesting aspects on cross-chain solutions. Now, what is your, in a nutshell, one key takeaway from this panel, from this discussion? Can you sum that up for yourself?
Sure, yeah, totally. I mean, I would say that over the time that we've been in crypto, we've often kind of seen it as like, this is a new world and lots of new ideas are coming up. Let's build them all quickly. And they don't all tend to work with each other. And now we're trying to figure out how to get that to occur kind of after the fact. And I think one of the things to get my head around, I guess, is that the liquidity and the cross-chain element is going to happen. It's more about how can we collaborate together to make it happen better for the consumers and the users, rather than kind of coming back to before, just try to launch another yield-bearing platform that competes with higher yield than the next one or whatever. But really try and spend the time thinking to really put in the work to develop what is happening, because it's already starting to affect the real world.